Hey everyone, and welcome back to the Handsome Trader channel.
It's great to be here.
Real quick, before we get into today's deep dive, if you could just take a second to hit like, share this video with a friend, and subscribe to the channel, it really means the world to us. We do this to help you guys out, so your support just, it keeps us going.
Absolutely. It really does help.
So I want you to imagine a scenario. Imagine getting into a major asset, like way earlier than almost anyone else on the planet.
Oh, the ultimate trader's dream, right?
Right. You spot this emerging trend, you build your thesis, and you manage to buy in at the absolute bottom.
Which is incredibly rare, just to point out.
Super rare. And then the asset plays out perfectly over the next decade. It validates everything you researched. But you walk away from the trade feeling like you completely messed it up, like you left a generational fortune on the table.
Yeah, and it's funny because that is actually the ultimate paradox of long-term investing. Getting the prediction right is only half the battle.
Or maybe even less than half.
Exactly. Executing that trade over a 5 or 10-year horizon is where the real wealth is actually generated. Or, completely destroyed.
And that's exactly what we're looking at today. We are doing a deep dive into the very candid confessions of veteran macro-strategist Raoul Pal.
Right. His famous 2013 Bitcoin trade.
Yeah. He bought in at roughly $200, which on paper sounds like a historic win. But he openly admits he kind of bungled the biggest asset cycle of his career.
And as someone who works with traders on their psychology all the time, I can tell you his mistake is so common. It's not about the math. The friction is always in our own behavioral psychology.
So today, our mission is to unpack his reflections. We want to extract these hard-won lessons on trading psychology, risk management, and, well, the danger of getting in your own way.
It's going to be incredibly practical for anyone listening who struggles with overmanaging their portfolio.
I like to think of long-term investing like planting a high-yield orchard, right? If you plant a little sapling,
Yeah.
and then you just keep digging it up every single week to see how the roots are doing.
You're just going to kill the tree.
Exactly. It's never going to grow.
You have to give those roots the time to take hold. And in financial markets, that soil is just uninterrupted time. It's compounding interest.
So let's lay out the timeline of Pal's massive misstep, just to understand the psychology here. So back in 2013, he writes this comprehensive macro strategy piece. He sees the potential of digital assets, and he buys in at $200.
A really bold move at the time.
Super bold. But almost immediately after he buys, the market just violently rejects the price. It slams down 90%.
Oh man, a 90% drawdown.
Right. For most regular retail traders, that is the ultimate capitulation point.
Oh, absolutely. I mean, the pain just becomes too immense. People take the massive loss and they swear off the asset class forever. They just say, this is a scam, I'm out.
But he held on. He reasoned that he was just, quote, a moron who bought the peak. But his long-term thesis was still intact. He thought it could reach $1 million over 10 years.
Which is a great mindset to have during a crash.
Yeah. So eventually the market cycle turns, and the price explodes from that crash all the way up to $2,000.
Wow. So that's a 10x return on his initial entry?
Exactly. By any traditional metric, locking in a 1,000% gain makes you an absolute legend.
Oh, for sure. You're feeling like a genius, like Stan Druckenmiller or something.
Right. He's feeling like a hero. But then the market gets super loud. There's all these network forks being debated, rumors of a bubble popping, the media's just screaming that it's over.
Ah, the classic FUD, fear, uncertainty, and doubt.
Yeah. Overwhelmed by all that noise and wanting to lock in his genius status, he sells his entire position.
Just completely exits the market.
Completely. And the problem, shortly after he sells, it goes up another 10x.
No, brutal.
No.
Just brutal.
He has to sit on the sidelines and watch it run without him. And then it crashes again, and he finally buys back in during the 2020 COVID crash. But this time, he's paying between $6,500 and $10,000 to rebuild.
Yeah, and that right there is the core psychological trap. It's this desperate human desire to improve upon a winning position.
Wait, what do you mean by improving a winning position? Isn't taking profits technically the smart thing to do?
Well, think about his original risk, right? He put $200,000 in at the start. If he had just lost his hardware wallet password, walked away, and done absolutely nothing.
Just literally nothing at all.
Literally nothing. That initial investment would have eventually scaled to around $100 million.
Oh my God. 100 million.
Yeah. But instead, he tried to be clever. He tried to time the cyclical weakness and strength.
But I totally get it. Like when you're staring at a 10x gain and everyone on TV is screaming that it's a bubble, Your biological instinct is to protect that money.
Oh, 100%. We are constantly fighting our own evolutionary biology in these markets. Protecting a massive win feels entirely rational. You want to secure the kill and run back to the cave.
Right. So why is it considered a mistake here?
Because applying that specific, active trading model to a secular growth trend completely destroys the magic of compounding returns.
Okay. Break that down for me.
Well, it highlights a fundamental difference between trading a traditional cyclical commodity like oil and holding a network adoption asset.
Okay, so oil versus, say, early tech.
Exactly. Cyclical assets oscillate based on immediate supply and demand. You absolutely want to trade those ranges because crude oil is never going to permanently scale to $1 million a barrel.
Right, it has a ceiling.
But a network adoption asset behaves more like a digital nation state that's experiencing massive, continuous population growth.
So because the actual user base is growing over the long term, the baseline value is just constantly shifting up.
Yes. The floor is steadily rising right beneath the volatility. So when you try to trade in and out, you're assuming you have the clairvoyance to predict the exact moment the market is exhausted.
Which nobody does.
Nobody. When Powell sold at 2,000 and bought back near 10,000, he dramatically reduced his total number of coins. He paid a massive premium to buy back the exact same network he already owned.
Wow, so he thought he was optimizing, but he was really just shrinking his own stack.
Exactly.
So how do we actually survive that desire to sell? Because it's so strong.
It requires a complete paradigm shift in how we process market data. And that really comes down to the charts we stare at every day.
Yeah, let's talk about the charts, because staring at a daily crypto chart or a high-growth tech chart is terrifying.
It really is. If you want to survive holding these assets without your amygdala just completely hijacking your brain, you have to change the visual stimulus.
So what's Pal's rule here?
He operates by a strict framework that you must view high-growth technological assets on a logarithmic scale.
Okay, whereas most of us, like most retail platforms, just default to linear price charts, right?
Right. A linear chart plots the absolute dollar value on the vertical axis.
And looking at a linear chart of these assets over 10 years looks crazy. Like the early years just look like a flat dead line on the bottom of the screen.
Yep, completely flat.
And then the recent years look like these absurd vertical straight up spikes. It's like looking at a massive city skyline from street level.
That's a great analogy.
Yeah, like everything just looks like these towering glass walls looming directly over you. It just creates vertigo. You don't see the structure, you just see these terrifying obstacles.
But a logarithmic chart changes the scaling. It measures the percentage change rather than the raw dollar amount.
So a move from $10 to $100
Takes up the exact same visual space on the screen as a move from $1,000 to $10,000.
Oh, because they're both just a 10x percentage gain?
Precisely. And when you apply that scale to a network adoption asset, that terrifying vertical volatility just vanishes.
And what do you see instead?
You see a remarkably smooth, consistent trend moving up and to the right over a multi-year time frame.
So it's like looking at that same city skyline, but from an airplane window.
Exactly. Suddenly you see the grid, the layout, the logic of it all. The chaos at street level is just localized noise.
And this chart is critical, right? Because it proves this isn't just random casino action. It tracks Metcalfe's law.
Yes, Metcalfe's law is huge here. It dictates that the inherent value of a telecommunications network is proportional to the square of its connected users.
Meaning, like, 2 telephones are a fun novelty.
But 1 billion interconnected telephones, that reshapes global civilization. The utility, and therefore the financial value, scales exponentially as people connect.
And this isn't just a crypto thing either.
Not at all. It's the exact same mathematical model that drove the success of the NASDAQ tech giants, Amazon, Google, Facebook.
Right. If you look at early Amazon, they had brutal drawdowns. They lost massive percentages of their market cap.
But if you zoom out on a logarithmic scale, it's a beautiful, elegant curve. The market cap grew precisely in line with the adoption of their networks.
So recognizing that you're just tracking a mathematical adoption curve kind of takes the drama out of the daily price action.
It has to, because the physiological toll of active trading is severe.
Oh, I know. Watching hourly charts just spikes your cortisol. Your brain is bathed in stress hormones with every little dip.
And operating in that state of chronic stress degrades your executive function. You make terrible decisions because you're in fight or flight mode.
You're acting like a cornered animal, not a logical investor.
Exactly. You're trying to manage your internal anxiety by messing with your external portfolio.
So to lower that stress, We need to set expectations. What does normal actually look like in these high-growth assets?
Well, normal here would cause absolute panic in legacy equity markets. You have to internalize that 35% pullbacks are going to happen multiple times a year.
Multiple times a year.
Yeah, and 50% drawdowns are going to happen every few years.
And that doesn't mean the asset is broken.
Not at all. It's just the required breathing pattern of a volatile market repricing risk in real time.
Okay, so if we know these massive drawdowns are mathematically guaranteed, how do we actually trade day to day without ruining everything? Let's get into Pal's rules of engagement.
This is where discipline comes in. Rule number 1, and this is absolute, no leverage.
Yeah, because leverage makes you feel invincible in a bull market, right?
Yeah.
You borrow money, the asset goes up 20%, and you feel incredibly wealthy.
The math looks beautiful on the way up, but it is entirely unforgiving on the way down.
It's a death sentence.
It really is. Think about the mechanics. If you're leveraged 2 to 1 and the market takes one of those standard 50% dips we just talked about,
Which we know is going to happen.
right, your position value goes to 0. You don't get the luxury of waiting for the market to recover.
The broker liquidates you, they take your coins, and you are kicked out of the casino.
Permanently removed from the compounding equation. You take an asset that already gives you leverage-like returns naturally, and you add fatal counterparty risk to it.
You turn a bumpy ride into a guaranteed margin call.
Exactly. Don't do it.
Okay, but even if you avoid leverage, holding these core assets through years of cycles gets boring.
Oh, incredibly boring.
Right. And then your buddy calls you up bragging that he just made 10x on some random meme token, like fart coin or something.
Right, fart coin.
And suddenly your disciplined portfolio feels super inadequate. How do we deal with that FOMO?
You have to address the neurochemistry. Our brains crave the dopamine hit of gambling. You can't just pretend the desire to speculate doesn't exist.
Because if you repress it, you eventually just blow up your account on an impulse trade, right?
Exactly. So Pal's strategy is strict compartmentalization. Rule number 2 is managing the Deegan bag.
The Deegan bag. I love that. How does it work?
You keep 3 to 5 core assets that have undeniable, proven network adoption. Those are your structural anchors. But to satisfy that human urge to gamble, you isolate a strict 10% maximum for pure speculation.
So 10% for the unproven protocols, the meme tokens.
Yes, but the boundary has to be absolute. You never let that speculative behavior bleed into your core allocation.
So if your fart coin goes to 0, which, let's be real, it probably will.
Your core thesis and the bulk of your capital are totally fine. It's just an emotional release valve.
That makes so much sense. Okay, rule 3, self-custody. This is about wallet hygiene, right?
Yes. Keeping your assets under your own control using hardware wallets like a ledger. Keeping it offline.
Right. Staying away from sketchy third-party sites or risky lending protocols. But you also mentioned that the friction of hardware wallets is actually a psychological advantage.
Friction is one of the most powerful tools we have. If your assets are sitting on an active exchange app on your phone, you are one click away from panic selling at 2 in the morning.
When you're half asleep and stressed out.
Right. But if your assets are secured on a physical piece of hardware, locked in a safe.
The sheer effort it takes to go get it, plug it in, enter the PIN.
Exactly. It gives your prefrontal cortex the time it needs to step in and override that emotional impulse.
Which brings up my favorite part of this whole deep dive, the dead client phenomenon.
Oh, this is fascinating.
Yeah, so when major brokerage houses audit their data to see which accounts perform the best over decades,
Yeah.
you know who wins?
People who are literally deceased.
Dead people. It's wild. Or people who just lost their passwords.
The data is incredibly sobering. These inactive accounts perform exceptionally well because they are entirely immune to behavioral errors.
They don't try to front-run the news.
They don't rotate out of blue chips into penny stocks because they're bored, and they definitely don't panic sell during a crash.
They just let that logarithmic regression
Yeah.
do all the heavy lifting. I mean, we are quite literally outperformed by absolute inaction.
It's a humbling thought for any active trader.
Truly. But for the living traders who still have to navigate this, there's one final rule from Powell. If the goal is to hold safely, how do we handle those massive 50% dips when they actually happen?
By maintaining dedicated cash reserves specifically for those events. When the market resets violently, your response shouldn't be terror, it should be calculated deployment.
So having dry powder ready to go?
Yeah. Yes. A 50% drawdown is the mechanism that generates generational wealth.
If you're fully deployed at the top, a crash is just a harrowing waiting game. You're just praying to get back to break even.
But if you have cash, a crash is an acquisition opportunity. You accumulate a larger percentage of the network at a massive discount.
Which just accelerates your compounding when the trend resumes.
Yeah,
You go from being a victim to being a predator.
exactly. High-growth vesting is really an exercise in emotional regulation. The loudest, most hyperactive participants rarely capture the life-changing returns.
It goes to the patient money. The people who find a proven adoption curve, secure their position, and just step back and let it mature.
You identify the rising tide, and you stop fighting the individual waves crashing on the beach.
Such a great way to look at it. And that actually leaves me with a really provocative thought for you guys listening to chew on.
Oh, let's hear it.
So, if deceased clients are historically the best investors because they don't have emotions, what happens in the future when autonomous AI agents start managing retail portfolios?
Wow. Portfolios completely devoid of human psychology.
Right. If fear and greed are just programmed out of the execution layer entirely, do all our traditional psychological trading metrics become completely obsolete?
That is a massive structural shift. The market psychology in the next decade could look fundamentally different.
Definitely something to monitor as things evolve. Well, guys, as we wrap up today's deep dive on the channel, please remember that everything we've discussed today is purely for sharing knowledge and exploring personal experiences.
Yes, this is absolutely not financial or investment advice.
Financial markets always carry significant risk. You must do your own thorough research and take full responsibility for your own investment decisions. Thanks so much for joining us. Hit that like and subscribe button, and we will catch you on the next one.